All right, let's jump right into this explainer and decode the rather complex Q1 2026 earnings report from Delek US Holdings. If you've been tracking the energy sector for a while, you already know that finding the real narrative behind a company's financial statements requires looking way past the bold headlines. And today, we're going to do exactly that, breaking down what is really happening beneath the surface over at Delek. So we have a really fascinating paradox here, and it perfectly sets up today's deep dive into Delek US Holdings, ticker symbol DK. Think about it. How does a company's stock price climb over 120% in a single 52-week period when they literally just reported a staggering $201 million net loss for the quarter? Sounds completely contradictory, right? Well, as we'll see, the market is usually pricing in a much larger future strategy rather than sweating a temporary quarterly setback. Here's our quick roadmap for the explainer. We're going to cover their Q1 financial highlights, the big spring turnaround impact, the core sum of the parts strategy, capital allocation, and we'll wrap up with valuation and market outlook. Okay, Section 1, Q1 2026 financial highlights. At first glance, a reported Q1 net loss of $201 million, which breaks down to about $3.34 per share, well, that might set off some immediate alarm bells. If you just quickly skimmed the headline of the earnings release, you might reasonably assume the company was in severe distress. But check out this incredible contrast. Despite that massive headline loss, the company simultaneously generated a whopping $461 million in operating cash flow over that exact same period. This tells us a totally different story. It shows that despite the accounting loss on paper, the actual cash engine of the business is firing on all cylinders, definitely aided by some favorable working capital changes. And when we actually strip out the non-cash adjustments and the one-time items, the adjusted EBITDA sits really strong at approximately $212 million. So this illustrates a highly profitable operational picture underneath it all. Honestly, it's a classic example of why we just can't stop at the net income line when evaluating a company's true health. If you follow the cascading blocks on this bridge right here, you can see exactly how specific turnaround costs, most notably the Big Spring refinery turnaround, labeled here as BSRTAR, temporarily skewed those headline numbers downward. You can also see market impacts and supply timing playing a pretty big role. The takeaway? It's absolutely not a permanent loss of earning power. It's just a temporary, planned dip. Moving on to Section 2, the Big Spring turnaround impact. The crucial thing to understand next is the why behind that temporary drop in net profitability, and that is the Big Spring refinery turnaround. Management confirmed on the earnings call that this vital turnaround is now fully complete. But more importantly, it was done safely, there were zero cost overruns, and it finished right on schedule. This is actually a massive win, because it means there are absolutely no additional turnarounds planned for the rest of 2026. Delek is now perfectly positioned to run at full capacity and capture those market margins for the rest of the year. You can see exactly where the cash went right here. A massive 93% of the parent company's $181.7 million capital spending went straight into sustaining maintenance. The bulk of that was dedicated specifically to getting the Big Spring facility optimized, safe, and back online. So yes, it was a heavy investment quarter for sure, but it fundamentally paves the way for future free cash flow. All right, Section 3, the sum of the parts strategy. Let's get into the real core of management's long-term plan, which is almost certainly what the market has been pricing in with that 120% stock surge. It's all about unlocking hidden value through their logistics wing, Delek Logistics, or DKL. You'll hear management throw around the word deconsolidation a lot. It sounds like heavy corporate jargon, but the concept is actually super simple. It's just a strategy of treating the midstream logistics business as a distinct, standalone asset to be optimized for shareholder value. Right now, the market kind of lazily lumps the refining business and the logistics business together. Delek aggressively wants to separate them to highlight just how incredibly valuable DKL really is on its own. The earnings transcript lays out 4 very specific paths management is actively pursuing to execute this deconsolidation and reduce their current ownership stake efficiently. They might grow DKL's cash flow through smart little bolt-on acquisitions or sell off specific assets to capitalize on private market multiples. Alternatively, they might have DKL buy back its own units from the parent company in a tax-efficient way, or potentially even pursue a strategic combination or outright sale of DKL entirely. Just listen to this direct quote from CEO Avigal Sorek. It shows exactly how aggressively they believe the market is undervaluing DKL. He says they believe the unit should have a 7 handle. What he means by that is a unit price starting with a 7, as in over $70 per unit. Considering DKL has been trading significantly lower than that recently, management is highly motivated to close that value gap. Which brings us to Section 4, Capital Allocation and Dividends. With that complex sum-of-the-parts strategy humming along in the background, how is Delek actually distributing its cash back to shareholders right now? Well, they're balancing aggressive operational optimization with reliable shareholder returns. During Q1, they paid out $16 million in regular dividends, keeping that dividend yield steady at around 2.39%. On top of that, they actually raised the target for their enterprise optimization plan, which is basically their internal cost savings program, up to at least $220 million annually. And to top it off, DKL reaffirmed their very strong adjusted EBITDA guidance of $520 to $560 million for 2026, which proves the midstream business is incredibly stable. And finally, Section 5, Valuation and Market Outlook. Let's tie all of this operational and strategic data back to the actual stock price. Looking at their illustrative valuation argument right here, specifically at the bottom line, they are calculating an implied valuation for DK anywhere from $92 up to over $120 per share. Now, one massive variable here is the regulatory landscape, specifically whether or not they receive small refinery exemptions, or SREs, from the EPA. But even if we look at the absolute low end of their estimate, management is making a very strong case that the stock is heavily discounted relative to its true sum-of-the-parts value. Now, looking impartially at the current metrics, we immediately see a very attractive price-to-free cash flow ratio of 5.55. That simply means the business is generating a massive amount of cash relative to its current stock price. But, and this is the elephant in the room, this has to be weighed against a remarkably heavy debt-to-equity ratio of 11.25, with total debt sitting out there at roughly $3.4 billion. That debt load right there, that is the primary risk factor the market is actively weighing against that otherwise impressive cash flow. So what's Wall Street thinking? Currently, the analyst consensus from sources like Zacks leans pretty bullish. They've set an average price target of $50.31 for the stock, suggesting an upside of nearly 17% from current levels. Analysts seem to really be buying into this deconsolidation narrative. They recognize the underlying value of the logistics arm, and they're anticipating a much stronger run rate now that the big spring turnaround is fully in the rearview mirror. So here is the ultimate question for you to consider today. Will this complex sum-of-the-parts optimization strategy effectively overcome those heavy debt risks and ultimately reward the investors who decide to hold the stock long-term? Management is clearly confident, and honestly, the sheer cash flow is undeniable. But the actual day-to-day execution of that deconsolidation plan is going to be the ultimate deciding factor here. What are your thoughts on Delek's path forward? I hope this explainer helped decode the numbers for you. Keep learning, and as always, stay curious.